Hello everyone, and welcome to today's presentation. My name is Amanda Davidson, and I ran Elevated Shoewear. Today, we will be looking at the performance of Elevated Shoewear in the BSG strategy game. The strategy that was chosen at the beginning of the simulation was the low-cost provider strategy. The low-cost provider's basis of competitive advantage is lower overall costs than competitors. In order to achieve this, companies can do this in two ways: perform value chain activities more cost-effectively than rivals, and revamp the firm's overall value chain to eliminate or bypass cost-producing activities. The advantages of the low-cost provider strategy include higher profitability. By reducing the cost to make a product, the margins will be higher than the competitors who need to invest more to produce products of a similar quality. Companies that are able to offer the same product at a lower cost will draw more customers, thus increase the market share. The success of the low-cost provider strategy rests on the ability of the company to reduce costs in production. If a company does not have enough control over the supply chain or external costs rise, the company will let that cut into the profit margin or need to raise prices, undermining their competitive advantage. As the company grows, it also increases in complexity. The low-cost provider strategy can become more challenging to implement. The company struggled during the first 3 years of the competition. Net revenue steadily dropped from $250 million to $215 million in year 12. Earnings per share and return on equity also steadily dropped. Most alarmingly, Elevated Shoewear's global market share continued to drop from year 10 to year 12. Things started to turn around for the company from year 14 to year 16. Net revenues consistently grew from $212 million to $308 million in year 16. Another positive indication of the company's performance is the increase of global unit sales. In terms of strengths, Elevated Shoewear was able to offer a wide range of shoe models for their customers. For the majority of years, this was a competitive strength of Elevated Shoewear. This type of characteristic is typical of a broad differentiation strategy, a strategy which aims to produce many product variations which appeal to a large number of customers. One of the weaknesses is the lack of strategic vision and long-term strategy. In the beginning, Elevated Shoewear decided to follow a low-cost provider strategy, but abandoned ship at the first signs of trouble, and did not reevaluate their strategic vision. The company has also vastly underperformed in returns of return on equity. Quickly after year 10, the ROE dropped below 10% and struggled to remain consistent. Looking at the performance between year 12 and year 13, one of the things that changed was the focus on increasing the SQ rating of the shoes. It is now projected for year 17 that the SQ rating will be 7 across all markets. Another change was to start offering free shipping to all markets. These changes have seemed to help the performance of the company. In the future, Elevated Shoewear is going to focus on 4 things: increase private label sales/production, increase advertising budget, keep shoe prices lower than competitors' average, and increase production in Latin America plant to reduce the impact of the exchange rate.